Hello and welcome. Before we start, please make sure to subscribe to our YouTube channel for news and updates. The S&P 500 recently declined 2.9% from its all-time high, while the Nasdaq pulled back nearly 5%. It's natural for investors to be concerned about where the market is headed, especially as the presidential election season heats up and the Fed prepares for its first rate cut this cycle. However, history shows that it's important for investors to stay focused on the long run and not overreact to every news headline. More than ever, staying level-headed is the best way to achieve long-term financial goals. Investors are increasingly responsible for their own retirements. This is especially true when it comes to saving for retirement. For those with decades until retirement, it's critical to start early and hold the right mix of assets that can generate sufficient growth. For those in or near retirement, sticking to an asset allocation that supports income needs while providing growth for longer retirement periods has never been more important. In both cases, investors today need an understanding of the retirement landscape and why they may need to take action to grow and protect their retirement savings. Over the past 50 years, the burden of planning for retirement has shifted from corporations and the government to individuals. Of course, when most people think of receiving checks in retirement, government programs such as Social Security are what come to mind. However, it's widely known that shifting demographics and longer life expectancies have put the future of the program in jeopardy. According to the latest report by the trustees of the Social Security and Medicare trust funds, Social Security reserves are expected to be depleted in 2035 unless Congress acts, at which point, fund income will be sufficient to cover only 83% of scheduled benefits. It's been the case for decades that individuals cannot simply rely on Social Security for their retirement needs. Investors must determine the most appropriate asset allocation for their goals. Today, the investing journeys for most individuals begin with their company's defined contribution plans, such as a 401k or 403b. The key difference is that defined contribution plan participants must select and manage investments themselves. As a result, they receive benefits in retirement from only what they have saved and invested, unlike under a traditional defined benefit pension plan. The same is true for other retirement vehicles that individuals can open on their own, such as IRAs. First, investors should hold a properly constructed portfolio tailored to their specific needs, including their life stage, risk tolerance, and more. In the short run, choosing the right mix of assets can help investors to weather the inevitable market swings that occur quite often, such as during the market pullbacks that have occurred throughout this year. Starting early and staying invested are critical for retirement. Second, saving early can help investors build wealth due to the power of compounding. The earlier an individual begins investing, the more time their money has to grow before withdrawals are needed. This is true even during periods of market turbulence, such as over the past few years. Finally, it's important to always stay focused on the long run, rather than worrying about day-to-day market fluctuations. Investing early and staying invested through the ups and downs of market cycles are the best ways to achieve financial goals. Trying to time the market or make sudden changes to a portfolio is not only difficult, but can be counterproductive since it derails investors from their true objectives. It can often feel as if there is always another crisis on the horizon, whether due to politics, the Fed, interest rates, or tech stocks. However, while there are no guarantees when it comes to investing, history shows that investors who save steadily and follow these key principles will be in a better position to grow their retirement savings. The bottom line? Today's retirement landscape requires individuals to take responsibility for their own financial planning. While this is challenging, it also creates opportunities for investors to tailor their retirement plans to their specific needs. Thank you for listening. For additional information, please visit mraadvisory.com.